All right, so your portfolio is chock full of technology stocks. You feel like you have a lot of concentration, exposure to the technology sector, and you're wondering if it might be a little bit too much and whether or not you should diversify. So today we're going to dive a little bit deeper on the bet that all of these technology stocks are making with AI today. And then we're going to give you a very simple framework of how to make this decision, decide whether or not you need to sell some of your technology stocks, reduce your exposure, or if it makes sense for you to not do anything and leave your portfolio alone for now. AI is an amazing technology. It's going to change the world. Why have any concerns? Well, the problem is that history is full of companies that changed the world, but also bankrupted themselves along the way in implementing their technology, in paying for all the infrastructure needed to bring the new technology to the market. And of course, today, the largest companies in the world are spending trillions of dollars, with a T, trillions of dollars on capital expenses to fund this amazing technology. Now, I don't think the majority of them are going to go bankrupt, but will they earn enough profits to justify the incredible capital expenditures that they're making over the next 3 to 5 years? Because you can't just have revenue growth. You have to have returns on invested capital, and those have to be quite high to justify this kind of expenditure. And so this is the largest bet, because if you zoom out and you think about the crazy amount of dollars that are being invested into these servers, the data centers, the power, the memory chips, conductor chips, this gigantic sum of money, all of that investment collectively is the largest bet that's ever been made. This is a bet. We don't know exactly what the future returns are going to look like, what the future revenues look like for this. So therefore, this is a speculative bet that the companies are making, that there is going to be a lot of profits on the other side of this. It's fun to just get caught up in the growth, see the amazing technology. It's sexy. It's awesome to think about the type of returns and the future that AI could enable. But there are some red flags that would suggest that it might not be as profitable fast enough to justify this spend. Of course, these red flags could be nothing, right? The revenue could come in spades. They could blow through all these concerns, and everything's going to be wonderful on the other side of this. But you still need to think about these risks, and then maybe you accept them. But if you just kind of ignore them, then you're not really being a thoughtful investor. You're just kind of riding a trend and hoping it works out well. And so let's talk about some of those red flags. The first one is just how commingled everything is, how interconnected and reliant these companies are on each other, and specifically the circular arrangements that many of them have in regards to revenue, services, and investment. So many of these technology companies are making investments in the models, into the semiconductor providers. Case in point, this diagram, which just looks like a bowl of spaghetti with all the varying relationships. And I'm sure a majority of these contracts were made at arm's length, and there's nothing nefarious going on here. It's just an unusual arrangement. When you're making a large investment in a company and then it's immediately sending you a lot of money back and paying you for your services, that's a weird relationship. That's a I pay you, then you pay me. Probably fine, but that is a situation that could be taken advantage of in order to boost money moving through the AI system, so to speak. And so each of these companies gets to benefit from all of that. And so I don't think they're triple counting this revenue maliciously. However, it is eerily similar to the telecom build out, the capital expenses that were paid to build out the networks, and the interrelated transactions between companies like Lucent, Nortel, that when the demand didn't quite hit the huge expectations, the whole thing just slowly unwound because they got a little too excited. They built out a little too much infrastructure. All right, number 2 red flag. How are they treating this spend, this capital expenditure on their balance sheet, on their income statement? How are these things flowing through the statements and showing up in earnings? Now, the problem with capital expenditures is that when you're paying for something that's an asset, you don't just show that major expense in your income statement, you depreciate that asset. And you come up with a schedule, a depreciation schedule, where you slowly deduct the value, say 1/5, 1/10, 1/20th, depending on the useful life of that asset. Now that's fine, but publicly traded companies and companies that are trying to raise higher and higher valuations, they have a bit of a weird incentive to inflate the numbers. They obviously have an incentive to make the numbers shine, to show rapid earnings growth, and to say that these assets are going to last a long time. And that's fine most of the time, but the problem is that they keep spending massive amounts of money on the newest and latest servers, which of course begs the question, should the depreciation schedules be shorter because you're constantly buying these things? It's really just a recurring expense to your business and not this long investment that you can slowly recognize and thus boost your earnings. Now, I'm not a technology expert. I don't know what depreciation schedule they should be using. I think there's only a handful of people in the world that know for sure what type of schedules they should be using for these investments. Most are just doing their best, coming up with a realistic timeline based on what they think they can generate from each of these assets. But we always focus on incentives, and their incentive is clearly to goose those numbers to the positive, to account for those assets on a longer time horizon, buying more time to advance this technology without taking that expense hit up front. All right, the third issue to think about is what is going to be the breakdown in usage between these frontier models and open source models that are much cheaper. Unfortunately, the best ones so far are from China, but there will be others. And what percentage of usage and spend is going to go to the very expensive models or the cheap ones that could just crank out a lot of the day-to-day functionality of AI for a tiny fraction of the cost? And you could see there's been a huge spike in the usage of open source model tokens. And I think this is a function of the last couple of months when businesses started seeing some of the spend, some of the giant bills they were spending with the frontier models, the open AIs of the world. And we're like, time out, we should probably slow this down a little bit. Let's look at cheaper ways to get 95% of the functionality of what we need. And then we can use the frontier models for our most advanced projects. And so, yes, I think there will be times when the frontier models come out with a new release and it blows everybody away for a little bit. But then, as we've seen time and time again, the open models catch up pretty fast. And then, of course, you have other entrants into that marketplace who are building their own models. So you have all these companies, some of the greatest companies ever built, and these unbelievable teams, and they're all focused on creating this intelligence. That is direct and ruthless competition. It sounds a lot like a commodity, this new intelligence commodity, where the price is slowly going to approach zero. And who's going to benefit from that ecosystem? To me, that sounds like a market where the customer is actually going to extract most of the value. Now, so far, that hasn't been the case. It's been mostly the semiconductor companies that have made all the AI money. But the question remains, will that continue? Maybe the semiconductor companies have a stranglehold on this market and are going to continue to make all the money. But once again, history has been unkind to infrastructure companies in new technology cycles. And if you don't agree with me, that's totally fine. But let's at least think through the past cycles here. We have the railroads. Now, this doesn't sound like amazing technology, but at the time, railroads were unbelievable. They transformed commerce. They opened up the entire country. Aggressive construction, a bunch of new competition jumped in, which led to this crazy overcapacity that made a ton of people broke. Yes, a couple of people got rich. Stanford was one of them, but the vast majority of people who invested in railroad infrastructure lost money hand over fist. The benefit really flowed to manufacturers, farmers, landowners, and the customer, the consumer. All right, number 2, fiber optic cable. This was the infrastructure for the internet. There could hardly be another technology before AI that was more transformational and more exciting than the internet. And of course, this is the most obvious parallel today because we knew the technology was going to be unbelievable. We knew the world would never be the same, and yet we still blew it. We just laid a crazy amount of cable. These companies took on too much debt. There was too much supply. Demand was there, but just not at the crazy high expectations, and prices tumbled. All right. The last example I'm going to use is airlines. Unbelievable advancement for humanity. Giant gains in global productivity. And yet, what a horrible business. Just an insatiable need for capital that never stops. And like AI, a massive need for expensive energy. And so in each case here, the technology was transformational, demand was booming, and yet the brave investors who risked giant amounts of capital to bring this new technology to life, to advance humanity, what was their reward? The vast majority lost an unbelievable amount of money. And so this is kind of a long-winded way of saying that being right about AI, being right about the promise and the productivity that it is going to bring to our world, it is not enough. I can already hear the people saying, yeah, but this time is different. I'm pretty sure it feels different each and every time. You honestly don't need to stretch your imagination that far to see the crazy productivity that could be gained from this technology, which, yes, it's going to lead to profits. I actually agree that is going to happen. I just don't know when it's going to. And does it actually justify the crazy amount of money being spent today? Because if you actually do the math, if you look at the return analysis on a potential $8 trillion of spend, then you start to realize that, wow, this really needs to generate a lot of profits like pretty soon. Because it's one thing to just get that money back to recoup that money. But then you also have to go a step further. You actually have to get a return on that capital because you had a bunch of different options you could spend that money for to get a great return. And was this worth it? This amount? Because even a pretty pedestrian 10% return on this spend requires more than 100% revenue growth each year for the next 5 years. So that's compounded revenue growth each year. But that's a lot more growth. That's in the range of possible outcomes. They could double, they could triple these expectations. Heck, maybe they grow 500% a year. But that's not really my point. My point is that the market already assumes that this massive growth is going to happen. In other words, a lot of optimism, a rosy future, is already priced into the valuations. And the higher expectations climb, the less room you have for delays, regulatory actions, and even new technology from companies we've never heard of. The broader point is that AI does not need to fail for AI stocks to underperform. The results just need to take a little bit longer and maybe be a little less spectacular than what the market is already assuming. Now, having high expectations for you and your family, that's a great way to live your life. But high expectations in an investment, not as great, because usually you have to pay up, because that means you're paying up for that asset and you can't afford for many things to go wrong. Because being right about the technology is only one part of the equation. You also need to be right about who's going to extract most of the profits, how much capital they're going to have to keep spending to just maintain those profits, and then how much optimism is already baked into the price. And so I'm not saying go sell all your technology stocks. We own some technology companies and it's been an unbelievable ride. This whole analysis is really more of a diversification question. Should you rebalance your portfolio a bit away from technology? Do you know the bet that you are making? Are you comfortable with how concentrated the market has become and how focused it is and how reliant it is on the near-term profits from AI? And that decision becomes especially important as you start taking the gas off your pedal in your career, because you're going to need your portfolio to fund some portion of your lifestyle for a very long time. And you probably don't want your entire portfolio riding on one bet. Now, if you feel stuck because most of your positions have a really low basis and you're concerned about the tax hit, you want to think that through, and you want to look at the various options to mitigate this exposure efficiently, there's resources down below. We can help take a look at your portfolio if you'd like. Thanks for watching.